Hello, good. Ladies and gentlemen, welcome to the session, The Reliability of Feasibility Study, and thank you also for choosing this hopefully very interesting panel. You'll be invited to take part also in this panel to make it as interesting as possible, so we would like to be a bit here, get some action into the panel in order to be interactive and also to also see your views on the topic. But yeah, I would like to start with a short introduction. You know, we all have seen valuations where the forecast is, you know, only going up, going up, going up. No real sensitivity analysis have been made. No crash scenarios have been made. But you know, we all know that from looking into the past, that there is always the next crash coming. So, you know, are these evaluations and feasibility studies factoring in potential downturns in the economy, in hotel performance? And, you know, also in this context, you may consider, you know, Paris and London properties have seen yields around 3%, you know, even management agreements, which I've just heard from Chris, have been ranging around 4% in Paris, which is unbelievable, I would say. You know, is this also the yield you may have to pay in 2 years' time or in 5 years' time from now? We just don't know. Even lease agreements with the Motor 1 in Vienna has been offered below 4%. So is that a sustainable yield? Yes or no? Something, you know, we may explore. Before we get started, I would like to take the opportunity in presenting the panelists. From my left side, Chris Winkelmann is Managing Director at Aareal Bank AG, responsible for the bank's special property lending. This includes the hotel, retail and logistic finance groups, as well as the bank's Turkish lending activities. He's responsible for the structuring, origination and execution of various forms of financing on both mortgage and corporate finance transactions, being active in North America, Europe and Asia. Prior to joining Aareal Bank, Chris was a consultant with Arthur Andersen and an MD at a boutique investment bank in Switzerland. Chris visited the International College of Hospitality Administration in Switzerland and held a BSci degree in hotel management and minor business administration from University of Nevada, Las Vegas. To Chris' left, we would like to welcome Peter Kulic is the VP Global Feasibility and Investment Analysis. Oversees and coordinates the Global Feasibility and Investment Analysis function across Hilton Worldwide's office in the United States, Europe, and the Middle East and Asia Pacific. His team's financial underwriting supports the development and real estate function at Hilton Worldwide. Peter joined the company in 2006. Then later on, in 2007, he was relocated to Europe to establish the feasibility and investment analysis function in the European and Africa region. He has been at Hilton Worldwide corporate headquarters in McLean, Virginia, in his role since 2009. That's where you're at the moment, isn't it?
Right.
Okay. So prior to Hilton Worldwide, Peter was a VP with HVS, New York office, and Peter holds a Bachelor of Science degree from the École Hôtelière de Lausanne in Switzerland. Okay, Zoran. Zoran is a graduate of economics from the University in Rijeka and a doctor in economics and business from the University of Trieste in Italy. Zoran started as an economist for development and marketing in Croatia for the House Building Co. He has continued as an independent economist for strategic development in the consulting firm Adriana Grania Commerce. Rightly spoken? Yeah, thanks. Moving to Italy, he was department manager for Construction Co., Costel SPA, and financial advisor for the biggest Italian construction company, Logiani Group. After '94, he continued his career in Central and Eastern Europe. Then he moved to London. He was a co-founder and partner of Infrastructure Capital Partners and managing director for Italian and Mediterranean countries for ICP. And yeah, besides his investment role with CAIB, IPA, I don't know what that is, but exactly, Kreditanstalt and ICP, he's a senior partner now and managing director of Horwath HTL in Italy. You know, one of the services offered is valuations. So the Horwath HTL valuation services have valued hotel properties all over the globe Their teams are internationally recognized experts in single asset and portfolio valuations. Last but not least, you would have counted with Arma. Arma can't be available at this time, so replaced by Bernard Foster, which you may know. Bernard joined the Rani Investment in 2013. He is working there as a director, asset management, hospitality and real estate. He asset manages the company investment notably in Mozambique, Zimbabwe and the UAE, correct? Correct. Rani Investment is a Dubai-based diversified investment holding firm for the Ojan Group, owning hospitality, real estate and aviation interests. He joined Rani Investment from IFA Hotel Investments, whereas VP Asset Management managed IFA's real estate portfolio outside of the UAE. Previous, Bernard was a director of HVS International, another time, based in London, where he was responsible for Africa, Middle East and Turkey. He started his career at Savoy Group in London, where he enjoyed various positions in operations. I guess we have no questions so far. So I would like to get started with a short definition, because when we have spoken in first place about this panel, you know, I noticed that we somehow mix the words a little up. We talk about feasibility studies, we talk about valuation. I just picked the exact definition for these terms. I would like to read them out quickly this time. Feasibility study is an evaluation analysis of the potential of a proposed project, which is based on extensive investigation and research to support the process of decision making. And the valuation, therefore, is the determination of the economic value of an asset or liability, or in other words, while feasibility is mainly initiated by owners or developers at the beginning, where at the creation of a hotel asset, for instance, the valuer later on is instructed by an investor who may, for instance, carry out such study in order to assess his purchase price, to confirm his purchase price. So therefore, you know, you see there may be different approaches, there may be different angles also from this point of view. Feasibility study also look at the cost side, of course, very intensively. Valuation, how typically could a hotel be sold or resold in a certain scenario. And yeah, myself, I come from Union Investment, which you may come across with. Union Investment is one of the big open-ended funds based in Hamburg, Germany. We've got 36 hotels with an entire exposure of 2 billion euros. And well, we are quite active at the moment in hotel investment. We've been acquiring 7 hotels last year. And this time, I'm very happy to be on this panel in order not to be asked more questions, but the other way around. I have the possibility this time to ask questions my panelists. And therefore, I would like to get started with Chris, with first question. Chris, at what stage and which purposes are consultants being engaged, and what is the scope of the market of feasibility and valuation studies? How have the requirements for these been evolving during recent years?
I think from our point of view, on the lending side, the valuations give you good guidance. By law, they're required in any case, but do give you good guidance as to what kind of leverage you're putting on within a certain loan amount. I think it's become a lot more complicated over the past years. Complicated, sometimes good in that sense, but some things are being overdone. However, the valuations are becoming a lot more detailed in terms of what they have to contain in order to fulfill our auditors' requirements. That is actually a valid valuation assumption on that. We've had a lot of discussions with many other valuers and also with the operating companies as to what is to be included in the P&L and what is to be excluded in the P&L. We've seen that F&E requirements are steadily going up. The fees are somewhat buried in the structure. So there's a lot more detailed work that we need to, in order to really persuade our auditors that our book values that we assume are correct.
So the studies are more sophisticated than they were like 10 years ago, for instance. Yeah.
Absolutely.
Yeah. Peter, can you share this experience?
Right. I mean, where we get involved from the operator side is it's more on the feasibility in the early stage of the development process. So I mean, we obviously, our team does the internal financial underwriting of the deal, but where we get where we communicate with the consulting community is on all projects we ask the owner to have an independent feasibility study done, and, so that's shared with us, and so that's we get involved, and it's how they evolved over time. It's we've certainly seen in some parts of the role that they've improved, but it's still, I would say the quality across the board it varies quite a lot, depending whether it's a internationally recognized consultant, or if it's a local consultant, and even within the internationally recognized consultants, you can have very depending, which office does the study, and within the office, who's the actual associate, right, who works on the study. So a little bit all over the place.
Do you see different approaches and individual, very much different results? If you ask one appraiser for feasibility rather than the other, or you think there is more or less a very common market understanding of how feasibility should be carried out and what the standards are?
I think the approach is generally the same. One of the bigger difference, and one of the issues we see sometimes, is that it's really hard to follow the consultant's logic, right? So you would have a lot of the descriptive stuff, which is part of each feasibility study, but really taking and connecting the dots from the macro to micro to the competitive set to how you penetrate the competitive set, so that me as a reader, I can make a conclusion as to do I believe this study is reasonable? Sometimes you kind of actually don't kind of follow the logic.
Mm-hmm. Soren, can you share this view maybe from your point of view as the servicer and creator of feasibility studies? What are the requirements from the customer? Have they changed a lot during the years? Or what is your impression on that?
We as consultant, our experience is that in last years, all the participants in the process have changed a little bit their behavior. They are all much more careful, from the owner, developer, bank. Of course, maybe we have to distinguish. Probably Chris was careful before. Also, in Italian banks, I have to say, the change was very strong, and they are now looking thoroughly to understand the project, while it was not always the case in the past. We are involved in the earlier stage than, let's say, operator company, and we have to say, unfortunately, I'm talking about my experience, we are called after only after banks have put the questions to the owner, not earlier, where we suppose the owner should understand where he's entering. So he's calling us later when the banks put the question, when the operating companies start to put the question, and we would like this to change a little bit if possible. So regarding scope of the studies, should I answer your first question, or we are trying to put all the participants in the investment process in comfort. What does it mean? We know that the project will happen only if owner is satisfied, if bank is satisfied, if operator is satisfied. But if there are no real assumptions, and if the project is not built on good basis, it is better that this project doesn't happen.
I also think there's much more of a focus of who's actually valuing your properties, because there's many, as Peter was saying, very international, specialized valuation companies that purely focus on hospitality. So I think if you're an investor, a bank, or anybody that's involved in that processes, you want to be sure that they possess a database that can actually show what the market is doing, what the market has been doing, how the market's reacting to changes in supply. And that doesn't mean that all of them are necessarily equally good in all countries. So I think there's valuation companies that are very good in certain countries and locations, whereas you'll have to take a more local approach in other countries because they're not as sophisticated, so you'll have to work with local companies that have somewhat similar bases in terms of information and data gathering. So the more advanced and the more progressed you already go to the US, you can basically look it up on the internet, etc. I think. But if you come to Europe and the more south you go, and I think that's also very true for Italy, there's just not that much of a database to really just say on a paper, that's what the rate is going to be. So you really have to have local people that are looking at the markets. I think that's important rather than just taking a value. Say you have a valuation company, just do hotel valuation. You might end up with something that's not really reflecting what you want.
What is your view and your experience in this field? How you're assessing it together with international valuers, or who do you choose? Has that changed over the time? And
it depends on our markets. We have quite a number of hotels and developments in Southern Africa and emerging markets. And, when we're talking about benchmarking and availability of data and research, oftentimes there's none. So oftentimes there's no Smith Travel Research. There may be one or two branded hotel in a city or a market. So you look at a feasibility study, it's entirely different. It's very much a bottom-up approach. It's a demand build-up approach. It's looking at development costs. It's focusing on replacement costs in order to get to a number that you feel comfortable with. So it's in terms of feasibility, we do a lot of our feasibility work in-house. We tend to involve, have valuations done as and when we require financing. However, getting financing in Africa is another matter. So it's not as straightforward.
And from your point of view, Bernard, have you made the experience that the consultants are ready to discuss their findings, or during the past maybe that has also changed and maybe consultants are more flexible? Maybe if you're giving good reason that they change, or do they usually come and they formed their opinion and that's it, and that's the value, and they like to be independent? And what is your idea?
No, actually it's actually quite interesting because as soon as you go to Africa, you don't have the big consultants, the big companies that are in America and Europe that are really well known. They don't really tend to exist in the emerging markets. So you're much more focusing on smaller consulting houses that have good track records in markets, and you actually end up with very good studies. My experience is, there are certain chapters in the feasibility study that I'd rather not show to bank, truth be told. It will be like a SWOT analysis in great detail. I don't really want to tell the bank about my threats and weaknesses. It's actually quite good.
Christoph doesn't want to. Okay.
But in terms of the communication, what we've been doing a lot is actually talking to the consulting community, and are open to any consultants that, if they say, you're doing a feasibility study for a proposed Hilton Garden Inn, right? Which is, one of our newer brands in this part of the world, right? I mean, we actually welcome the consultant giving us a call, just because we can really explain, as to what the brand is, and go to the level of, like staffing by department, and, like give them as much detail, around the brand, right? Because there's nothing worse when you have a owner, right, that does a feasibility study for a specific brand, right? And then, we look at it, we're only receiving, and it's like, well, actually, that's not really how the hotel operates.
Okay, and then you're usually successful in telling them, well, that's not what we wanted to see. Please consider. Well, it's this particular product in this market, and you've got usually good arguments to discuss, or is it really hard to?
No, I think in general we have good arguments, and it doesn't. It's not only on the new brands. Like, I mean, we just mentioned the sophisticated markets like the United States. I had last week one of the managing directors of one of the large consulting firms giving me a call saying, hey, you know, we haven't been doing feasibility study for, we're doing a feasibility study for proposed embassy suites, you know, one of our market leading brands, but, you know, well established. And it's like, you know, she was telling me, you know, I know there's a lot of things that have changed, but within the brand, you know, who can I talk to in the organization to really understand what the brand is today? Because, you know, each brand evolves, right? And, you know, the study is as only as good as, you know, the consultant understands the brand.
Okay. And now usually the consultants' forecasts, are they more or less in line, or are they higher or lower? Is there? It's
interesting, right? Because you would think that, you know, when we do our numbers, that, you know, we would be, say, more optimistic. I think, you know, on balance, we're, you know, we're probably a little bit more conservative, you know, on balance. I mean, there's different exceptions, obviously.
That, as I said before, and really, I think depends on whether an owner wants you as a brand or whether you as a brand want the owner to take you, right? That also probably has an effect on the divergence of maybe
I can tell you one thing, right? That, you know, from our internal perspective, we have one set of numbers.
Of course.
Right? That's one set of numbers that, you know, in case, you know, those numbers, if they are shared or if they are used internally, I mean, our primary reason, you know, for our existence is to do internal underwriting, right? So we want to make sure that, you know, whatever numbers we produce are, you know, reasonable to us.
Okay.
May I maybe comment? It always has a very negative connotation that anybody involved, whether it'll be the owner, the operator, or the lending party, that talks to the value and tells him what's wrong or what's right. And so the one side is trying to push a value into a certain direction up or down. That's the one thing, depending whether you buy, the seller, the financer, or whether you have good arguments of arguing something that's within the valuation. There are mistakes in the valuation, or there's supply coming into the market that nobody has thought about or that somebody has heard about. So I think there's very constructive discussions. I think from my understanding, the first raw cut should be really done by the value. We'll leave them alone. I mean, they'll go to you and look at your projection for sure, and they'll look on the owner's side as what the product will be. But at the end of the day, the first set of documents should really be done by the value, and then thereafter, you know, there's always discussions. But again, I refer to constructive discussions in both ways, you know. So it's got to be very sensibly held. Otherwise, you're being told that you have pushed the value in a certain direction, and one party is unhappy with that.
Okay.
I think it's quite interesting what you just said, but it's also difficult from a valuation perspective, where you have a typical methodology, a DCF approach, where the first 3 years have, you know, significant impact on the value. So from a consultant's perspective, I find that the first year of operations is overstated, in the sense that the occupancy is typically higher than what the hotel will typically achieve. So, but then if you go back and reduce the occupancy, you know, your value is out of skew. So it's one of those tricky ones. So you from a consultant's perspective, push up the occupancy in year one to get to a reasonable value that's close to your replacement cost. But equally, it probably won't happen in reality. The occupancy won't be
There's a
there.
little bridge we could use for that. We call it the as-is value and the as-stabilized, right? You know, that usually does the trick.
You know, the interesting part is, you know, for me, coming from the consulting background to the operative background, we obviously have one benefit of actually, you know, 'cause our work is not done when the deal is signed, right? Because then ultimately, you know, the hotel gets built and it gets open. So we have the benefit of actually seeing how these hotels opens and ramp up. And, you know, it really goes back to, you know, to the assumptions, right? So if you have a good feasibility study that clearly lays out the assumptions, you know, then you can actually go back and look at, well, you know, how did these assumptions, did they happen, did they not happen, did they happen differently? And, you know, 9 out of 10 times, it's not necessarily, you know, if you miss year one, is that, you know, because some of those assumptions just did not happen.
Yeah. When excursion in the world of lease agreements, you know, when we instruct valuation for lease agreements, we came now to our opinion that we in principle that the forecast being calculated, and we take the forecast and do our own models, but without any valuation itself. the reason for that is that, you know, on the lease, you're working with certain coverages, and, you know, each, from my point of view and from my experience, each appraiser has a different idea and a different approach. What is a sustainable coverage on the lease? One may think a 120 coverage on the lease is adequate, and the other one may see 130, and then, you know, if you apply 130, you may come up to a much lower value than if you have a 120 coverage. So this also tells you, you know, from a lease perspective, there are also different approaches, and, you know, we so far haven't somehow came to the point that there is like a standardized approach. You know, this is the sustainable lease level, and which you may derive a certain value out of it. You know, that's small excursion from the lease agreement world, which I think I'm the only one representing that model here on the panel. Going to the next question, Peter, you were already touching base about what makes a feasibility study good. What do you expect from a good feasibility study? What is the point which tells you, well, this is a really good one, or is it like 60 pages booklet and 20 pages some rough calculations, or what is the point? How can you assess that?
You know, obviously the requirements in feasibility studies are, you know, less than, you know, on a full-blown appraisal, right? So I've seen some feasibility studies that were 30 pages, and I thought they were excellent. I've seen feasibility studies that are 200 pages, and you know, going back again to the point, you know, I couldn't conclude if it's reasonable or not. So it's really, you know, connecting the dots, you know, really having the reader, because at the end of the day, right, there's no right or wrong answer, right? The one thing that, you know, we can be certain of is that the numbers, you know, that the hotel will not perform exactly the numbers that, you know, you project, regardless of how good consultant you are, right? Is that, you know, no one can forecast, you know, what the stock market will do tomorrow, right? So it's, you know, if you're forecasting a hotel that opens 3 years from now, you know, it's you know, quite, you know, difficult to get all the assumptions right. But, you know, then it's really identifying, you know, to me it really comes to the key section of supply, demand, and penetration, and, you know, as to how you identify, and then also going, like, you know, the next step, you know, don't just tell me, like, okay, we identify these hotels as competitive. Is it, you know, why did we identify this concept? So we've done, internally we've done a lot of training, and, you know, so the, you know, there was one benefit is we don't have to write internally 200 pages reports, right? So, you know, for each project internally we write, I don't know, 3 to 10 page assumptions document, but, you know, it's really kind of goes to the point, and you know, like, you know, again, building the argument, and then you know, as a reader, you know, if you can build the argument, then you can really assess, you know, hey, that's a reasonable, or, you know, well, we don't agree with this point, and that's why it's probably too aggressive or too conservative.
Okay, Bernard, do you have situations where you weren't really not content with the feasibility study at all, and you were asking just for a second opinion because you were saying, well, this is so disastrous, I just need another opinion, or is that more the exception?
I know of somebody or an investor who's asked for 3 opinions, and in the end he picked the highest one, but that was a purpose because he needed some funding. But no, typically, you know, we look at valuations from a funding perspective, and, you know, it's important that the story that it connects, and, you know, you can follow the assumptions, and it goes all the way from typically what happens. Everybody speaks about the market and benchmarks and research, but then suddenly we get to occupancy rate, and the next minute we get to a 10-year projection, and we don't really know how we got there. So it does happen, but I would say that's actually relatively rare. I think, you know, most consultants nowadays have pretty sophisticated models, they have good research, and I haven't, you know, come across anything that's so out of kilter.
So from your point of view,
yes, my experience as consultant is that we never had a case where when sector expert advisors were involved, that there was a request for a second opinion. This changed, of course, if by any case, non-sector expert advisor was involved, and then we find, let's say, difficult to understand what is real feasibility of the project if the market was not properly analyzed. And another issue which is very important, which we see as one of the most important in hospitality industry, is concept definition, especially in greenfield projects. So if this is all properly done, we haven't had a case where there was need for a second or third opinion.
And the other way around, are your customers often calling you and saying, well, we need to sit down and have a look again at the forecast, there is a bug in there, and
consultant has to be always available for discussion and argument his positions. We are always open, and we are, to be honest, happy. My experience is that when the owner is not put in question, you have to be scared as consultant. It means that sooner or later problems will come out. So this is our position.
Yeah. Okay.
But also, I think sometimes it depends on what the motivation of the owner is, right? And you have, you know, that if the owner's motivation is to kind of have the project, build it, and or sell it, sell it as a concept, right? They very often are super happy, if they have numbers that don't make sense but look good, right?
Yeah, exactly.
Sorry, but you have always other side. If you are selling, you have a buyer on the other side.
Right.
If they are asking for financing, they have a bank. If they want management agreement, they have to come to you. So there is always
some balance.
And talking about the different approaches, because in a different situation, I somehow have the impression that the approach is somehow different. So, for instance, in a sales mandate, the approach is more favorable and more going up. And then on the other side, if you ask for an independent valuation, then maybe a bit more conservative the approach. That was at least my experience. How do you deal with that, Peter and Zoran? Or do you always take the same approach, whatever the purpose of the valuation is?
Basic assumption is that consultant shouldn't be in any way connected to the transactor. This is at least my experience from other industries, where Chinese wall is very clear. You cannot stay on all sides of the story. When it is coming from the same source, I mean advice and transaction advice, then there is a conflict. In my opinion, if a consultant is completely independent, his results have to be always the same. In all situations, buyer, seller, bank, whomever. There is another thing which is, I think, very important to underline, and is that what we are usually doing, as Chris has mentioned, as is, what is actually the value of the business in this particular moment, considering all ongoing P&Ls. And then what we usually do, this is a low side of the range. A high side of the range is a potential. Then it's pretty clear what is achievable value of the property, and it depends on a negotiation between buyer and seller. What buyer will recognize as premium on the potential of the property. This is how we see it, and we always.
I think to somewhat mitigate that, the banks, for example, will require that they instruct the valuation. So then if it's a sale, the seller will try to influence somewhat the value of saying, well, the value is higher. The buyer will say, well, no, CapEx is needed, we found the pipes are broken. So, but I think it's good input from both sides. At the end of the day, the value gives a value to us. And whichever way that comes out, I think the most important one is if you do not understand hospitality, they will be able to tell you anything. And you'll be saying, okay, you're the value that's supposed to be that way. And whilst they're probably right 99.9% of the time, as you said, there is a slight margin for error. So when you look at these valuations without knowing the hospitality industry, they're worth as much as the paper's really on there, and it gives you good guidance. I think it's important that whoever is the addressee, whether it's a feasibility study for the owner or a valuation for financing for the bank, is that the people that are actually recipient have the know-how to go through the valuations, question them, look at assumptions, and then at the end of the day, make up their own mind as to whether that value is the right value, or low or higher value. Because to just go in and say, I'll push all that blame to the value and say, well, you told me that's the value, and you don't do a good job in terms of analyzing it yourself, I think that's where things have gone wrong in the past, whereby there was too much reliance on the value, and they're human beings at the end of the day. You were as well, as you said, you're probably within the range, right? And if you're saying you're talking to 3 different values, they should by book be plus minus 5, maximum 10% of value. That's what they should come out. If you have a value coming out with 50% higher values, you have an issue, and there's something fundamentally wrong, regardless of the methodology that they use. Some use it 10 years, some use it 5 years, all a mathematical function. So, but they should come within the range because they need to look at market evidence, what are assets trading at, is it the 4% or is it the 6.25 for your lease contract? And you can't assume, oh, it's a 4 for a lease contract, because that we haven't seen in the market. Right? So I think you really have to have, in order to really value a valuation, you have to be able to understand what it's in there.
Yeah, okay. Do you see a big difference between free and clear values and values under certain management with a long-term management agreement in place? Is there often a big difference from your experience?
There are definitely large differences, but that can go both ways. If you're in the middle of nowhere and you're putting on a 4 seasons contract, that might look very nice, but maybe 4 seasons is not the right operator for that market. Whereas you might be sitting in New York and you have a very large competition, you're putting a 4 seasons, and that is a coincidental manager, there's no sponsoring. You put into New York and they might be able to really exceed the competitive set just because of the way that they do business. So it might be a very bad thing to have that in the middle of nowhere before seasons, because it's a drag on your performance, because you maybe like to have mom and pop run your hotel and they know the guys around and they'll get a much better rate. So it can be very positive, it can also be very negative. I think that the general assumption is that having a manager, you're creating somewhat of a value because you're paying for something that you think at the end of the day somebody else can do better than you can. So from that point of view, I think the general tendency is if you have the right operator, your value should be higher than a free and clear. But also saying that in the past 5 to 6 years, of course, have shown that to many of us, or many people at least, that could also be a very negative drag.
Yeah, we've actually made the same experience on the lease agreement side in this very hotel you're sitting in, the Intercontinental Hotel. We've managed to sign a new long-term lease agreement 2 years ago, and by doing so, we've managed to save the value for the property, and the difference, of course, as you can imagine, has been tremendous. Of course, having a good operator here who is paying your lease for the long term is a real security, and is also a real asset, and therefore you can see big difference between free and clear values and values under lease or management agreement situation.
I mean, I just wanted to pick up on, you're talking about the value. I mean, the value is one thing, and it's very important, but it's the underlying cash flow. So if you've got a fantastic value and your cash flow can't support it, from our perspective, we just look at the cash flow. What can we actually support? What is the debt cover ratio? And that's the most important for us. And then we look at we have quite a lot of development, so we look at funding in terms of the development, but the cash flow is king. So.
Yeah, the cash flow is then, of course, dependent on who is the operator at the end.
I'm talking about the net cash flow, not the EBITDA. So
yeah.
I'm by the way in full agreement with you, because at the end of the day, the property can have the nicest value, but if you value it at 1 cap, you'll never be able to make any returns, or at least very low returns. Some think that is a good return. what is important though to really see, and I hate to break it to you, I think that evaluation at the end of the day is a good time judgment, as you said, 3 years out, even 1 day out. You know, you'd be sitting in September 10th is a bad example, in 2001 in New York City, and you have a valuation on your table, great, it's worth 100 million, and you'll do the same valuation 2 weeks after, and it's worth 40 million, and you'll do the same valuation a year later, and it's maybe back up to 80, 90 million, and now it's probably 200 million. But I think it's a very point of time that evaluation gives you the very best assumptions that you can take without having any other influences, but you can't really predict a good value. And at the end of the day, you're very right. We can look at a 40% loan to value, and it looks all great, but it's at that point in time not able to service debt or has no cushion, then that's not of interest for anybody, at least not for us it wouldn't be. So very right, it's the debt deal.
Yeah, exactly. Soren, we talked earlier about the potential to get the commitment from the evaluator for his results, and I would say that, of course, taking all the factors into play, evaluator can't really find, you know, the 100% truth. Maybe he can get an approach to the truth in that very moment, but he hasn't got a crystal ball and see into future what the values would be like. So therefore, I assume you can't be held liable for your results, or how is that played?
Consultant should be always liable for what he is paid. Mm-hmm. This is
the fee for the study.
Exactly. Or
maybe the PI insurance.
or in particular cases it could be 1.5 or 2.
Yeah.
I would be of a different opinion, because if you go to the doctor and you pay $100 to have surgery, and then afterwards you have a leg less, unfortunately, and he's going to say, "Oh, sorry, it's your $100." I think I'm very different opinion.
If you tell me where I can find surgery
that's exactly
for $100,
I'll go there immediately. Look at the doctors; they're all shutting down because they can't afford insurance anymore. Yeah. So I know, but there needs to be something in between, because I think at the end of the day, if you would find me a value that would guarantee my value, I wouldn't have to work anymore, because it would be very nice. But I think that there should be something in between, for something that you couldn't have foreseen and something that you should have foreseen as per your blue or red book. I think those are the things that will be more of importance going forward.
But from my point,
these things, old Latin said, "Cavit emptor," buyer better be careful. Yeah, so you are buying what you are buying. You cannot. I mean, consultant is giving his best knowledge at certain point. On you is to choose consultant which is sector specialist, or any other consultant which cannot guarantee. So, and then a serious consultant will, it is not absolutely true that consultant is simply selling the study and not seeing it anymore. A serious consultant will follow the project and try to understand what was wrong, what was right, and to use this experience in
very valuable
next project. So
exactly.
That's why I think it is not propaganda, but next year we are celebrating 100 years of Horvat HDL. Maybe it seems that it will mean something.
Yeah. Okay.
The positive side, I think, is that at some point throughout the process, I think the very bad studies get picked up by someone, right? So 2 weeks ago, you know, we looked at a study, and we literally, you know, went back to the owner saying, "You need to get your money back and have them redo it, or have someone else do it," because this was just like literally the worst study we've seen, right?
Yeah.
To the point that, you know, you could not even. There were projections, but actually the study didn't identify. Was talking about competitive set, but never actually said who's in the competitive set, right? It just literally was missing like some huge chunks, and of course, you know. So this was it was a first-time hotel owner, so they themselves, they believed that actually what the consultant gave them was a reasonable projection, and they are talking to us, and we went, look, we're actually not interested in this site because we don't believe there is market for a hotel in this location. And they said, well, I have a projection, 70% occupancy. So we looked at it, it's like, yeah, get your money back. We would love to talk to you about we would love to do a deal with you, but not at this site.
Okay. And Peter, we also talked about earlier about the expenses and the forecasting of expenses, which is done only on comparable ratios. Is that good enough, or should consultants increase their effort and start building up the expenses on a pro forma bottom-up approach? So what is your view on that?
Well, it's actually one thing where we've done tremendous amount of effort internally at Hilton of actually, just going away from just purely using comparable, operating statements. I mean, still looking at them, but we obviously have the expertise in house and all the data that actually goes to staffing by department, so we can build the pro forma bottom up and and understand where the how many people per department. And I think from the that's probably the next step in the evolution of studies is actually looking more into the cost, because if you think of like a traditional feasibility study from consultant standpoint, right, as to how much time you spend on different components, right, the P&L, the expense side, that's actually done relatively quickly. Right, you pull 4 comps, 5 comparables, and you pick a number, and you kind of go down, and you're done, right? And I think there's just much more that I think could be done, going forward. Obviously, it's especially in markets where you don't really have. If you have 4 or 5 really good comparables, right, it doesn't matter. But think of market where you're the first international hotel, right? I mean, what comparables do you really use?
Yeah.
I think that is much more insignificant, especially on your side, on the feasibility side, because every hotel is unique, as we always know, and yes, there are comparables, but I think that, there's certain levels, your walkways, and unless you build a box that's been built 20,000 times, then it's easy to copy. The issue is that would be a lot more expensive, a lot more time consuming, and the only ones that really have that data is you guys, because the valuers will not have everything done to the payroll, usually. I mean, they can probably ask, but that's not normal. Whereas I think that on an existing hotel where you do valuation of a functioning hotel, I think you can use the comparable approach much better, because they're comparing where are you off compared to your competitive set, and what do you think you can improve. And there you can still go into major set-offs and go, okay, why is this so much different? You can go into detail. So I think on an existing hotel, you can use the comps much better than on the feasibility, where I think you should build it up at the bottom. And I do agree with you that many times you talk 90% of the time on the top line, i.e. occupancy rate, and nobody cares about the bottom line, because you plug in the numbers, everything else comes out, and then you come to the day of opening, and suddenly you got to, oh well, in a second we forgot the real estate tax is double, because we used a comparable. So that's very important, I think.
Okay, Bernard, from your point of view, is there room for improvement in communication between the consultants and the brands? Does the consultant always understand the brand, how it's positioned, and what the operating model is, or do you think there should be a deeper approach on that side?
It's quite interesting. Peter was saying earlier on that a lady in his feasibility team came to check out what brand repositioning within Hilton was all about, and how to model that within Hilton. So the question is, if somebody within Hilton needs to understand the brand within Hilton, the question is, how the consumer or anybody else is going to understand that brand. So, if you pick on a consultant, I'm not so sure if the consultant is going to be looking very specific on a specific brand. I mean, he looks very much at the positioning, is it upscale, is it upper upscale, is it luxury, rather than, and then he looks at the actual physical development. Is it is it this plain vanilla type high-rise building, or is it some sort of resort with, rooms over many hectares of land where it's very expensive to operate? So that's probably how the consultant would look at it. But Zoran, you.
Yeah, exactly. We are not doing studies for the brand. We are doing studies for the market, and then we choose or select to whom, when we have, of course, a mandate of operator search, then we choose a panel of the potential operators.
Okay.
And in a second stage, dealing with the operator, it comes closer to the specific brand. Recently, we started with a double tree in one negotiation, and we ended up with Hilton by Hilton, because at the end we concluded that this is better brand, although it has higher costs, of course.
Okay, so dear audience, now it's your turn. I would say, if you have any questions which you would like to raise, I've heard we haven't got any microphones prepared, but if you like, you can use mine or talk out loudly. So questions, please. Yes.
Or James from McKinsey. My question is whether you have the feeling that the feasibility studies sufficiently reflect the age of buildings and the specifics of buildings, of existing buildings.
I have a saying for the hospitality industry, it's mostly under-demolished, not overbuilt, so I would go to your point. But I think that today we are very much focused on it. Us as lenders, I can only say, we're very much focused on the age condition of the building. It goes down to HVAC systems, to boilers, etc. So we have a full technical diligence done on our behalf as to what state the building is in, and then really incorporate that into either a net F&E budget or a renovation plan, that whatever is recommended at that point. And so we put a lot of effort on what needs to be invested.
Okay. Further questions? Okay.
Yeah, hi. I'm Roger Allen from Famarian. We develop leisure complexes and do a lot of feasibility studies for complex spa leisure developments. And my comment or question is regarding this specific area, because I come across a lot of feasibilities, particularly for resorts and destinations, where you see kind of the 2 or 3 pages where the consultant's comment is, you build 4,000 square meters of spa, swimming pool, a few treatment rooms and a sauna, and that's it. And then the revenues, when you look at the P&L, is like hidden within other departments. And you've got, a complex, huge investment to bricks and mortar, and there's actually no transparency. Now, it's good from our side because we have to then go in and almost do a feasy for that specific area, but I definitely think that hotel management feasibilities could do a little bit better job in creating transparency and clarity there. Particularly because spa consultants in leisure are very kind of airy-fairy, and there's a lot of focus on placing of candles and dolphin music rather than the financial elements. I know I'm being a little bit ruthless, so hopefully there's no other spa consultants in the room. And that can actually safeguard the investor. So I think it's extremely important, because from the hotel segment, you could really take control there and protect the investor's element from poor spa consultants.
Okay, but I understood you right that in principle, you find that the costs are somewhere hidden, and No,
I'm not. I'm not fine. I mean, I'm all for. I'm not going in and saying build 3,000 square meters.
Okay.
I'm the one who's saying, well, we need to put some financial numbers on your return on investment for spa. I'm not the one who's saying, well, if you build a spa, it will increase secondary spend, there'll be occupancy factor, blah, 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 blah. I'm the one saying, well, we need to put a value on that. Do you need to build 1,000 square meters? If it is going to increase your occupancy, by how much? So I think from the feasy side, right at the beginning, that could be a better job.
What you just said is, it's a very good point. Well, what's missing, I find, is any sort of benchmarking data, because everywhere we look, we've got occupancy, we've got rate, we know everything about rooms, but we don't seem to know an awful lot about spa revenue. So, I think any consultant out there, if they were to do like a spa benchmarking type report, and it's the same for, conferencing, meeting, event space. I mean, what's the occupancy on those on these spaces? I mean, how often are they actually let out? What is the rent per square meter if you work it out? I just don't think there is really enough comparable data, even in a place like Europe, let alone emerging markets.
Sorry, Bernard, I have to correct you. From our perspective as a Horvat, we have built up practice, which is not by case, with a head office in Bangkok. which is dealing exactly with the question.
You need to get it out there, more exposure.
Yeah, because, and we are dealing there with 3 levels. This is, first level is a simple spa, hotel spa, then it's wellness center, and then it's wellness destination. And this is very different from the rooms and has to be studied very thoroughly. And we are doing it in a part of the world where this, let's say, these services are much more required than in Europe.
I would agree that on balance, right, you spend 90% of the feasibility study or appraisal deals with 60% of the revenue of the hotel, right? Because everything non-rooms is you can take it further, right? Even food and beverage in general, right? Is that again the availability of benchmark data is challenging, right? So it then comes to the experience that the consultant that you retain, right, as to how much experience they have with this hotel, how much internal data they can use to really benchmark the use the benchmark in the feasibility study.
I think if you look at any resort development, and I'll just take anybody, I'll take you. How many restaurants do you want in a resort? Very quick, how many?
3.
Only 3? Then
4.
Yeah, let's say
Depends.
4 to 5. And then you go, okay, great, 4 to 5 restaurants, that's fine. So I'll agree with at least 1 or 2, fine. And I do appreciate a resort needs to have, especially if you like, for example, take the Maldives, right? You're sitting on that island, you need to have 4 to 5 restaurants. However, what we've seen in a lot of resort developments is I want 5 restaurants. And then you go in and ask, okay, you got your 5 restaurants. These are my costs, by the way, for each restaurant. And this is the additional cost, so this is 3 versus 4 versus 5. So how much revenue will you generate with 3 restaurants, and how much with 4, and what is the 5th going to bring you? And it's then when the music stops, because they go, to justify the 5th restaurant, you really have to have a very good case. I'm not talking about Maldives, no, I take it back to Europe, right? Because there's just such an array that the operator would like to have 10 restaurants, because it's great for the guests. But the question is it really worth doing it? And I think you should be very shrewd. That is less our job. I think it's more the investor job to really question, okay, you want a restaurant? No problem. What's the return on my investment on that?
Right, I think it's balanced, right? And any discussion is good, and we actually do welcome those discussions. It's a balance between as to what is the brand and what you would not open a resort with just 1 restaurant or just outsourced outsourced restaurant, right? So it is a balance of being able to to deliver the overall experience to the guest. But then balance, I do agree.
So to your point, I think it doesn't only stop at the spa, which when it's in-house, you have 2 little treatment rooms. I think that would be going overboard because the investment doesn't really work.
Of course, yeah.
But the moment that you have restaurants, big spas, somebody wants a golf course, I want a 3rd or 4th swimming pool, and I think those are the things. I want the gym, and I want a big gym because my guests like to work out, which is all great, it's all fine, and you can build a golden palace. But I think it's very important that every P&L, every revenue generating department really question. And there's very good reasons to have 5 restaurants. I'm not against 5 restaurants. But
well, actually, we've just recently, we had a client that, this big developer, this was the first resort project, and they actually asked us, saying, okay, well, we would like actually to go retain a consultant to actually advise us as to what we should build, right? What should be the size of the hotel, what should be the facilities, there will be a residential component. So we actually help them, look for consulting firm, and so we kind of, and I think it's actually works really well, right? Because you have the consultant right at the stage of actually recommending facilities, and then then it gets to us, and they will negotiate a contract with us, and hopefully at the end, you have a product that's well balanced from every angle. Sometimes the challenge is that, it's, I know those studies, especially when you talk about recommending facilities, they become costly, right? So, you don't have every owner that, even though it's a huge investment, they don't necessarily want to spend, I don't know, whatever the cost of the study is, right?
Which is funny. Yeah.
Okay. Well, one would hope that after spending millions, total development, they'll be able to spend $50,000 on a feasibility study, but it's another matter.
Good question.
Okay. Any further question? Yes.
Yes, I'm Serge Belinga and I work for African Export-Import Bank. We are based in Cairo. We are currently financing a number of hotel projects. And for that purpose, most of the time we seek an independent view from an independent consultant. So I heard one of you saying that bankers are always involved, consultants are involved when bankers are ready to approve or start raising questions, or operator started raising questions. So the first question is, I'm wondering, is that true? Because I've seen many of the project feasibility studies prepared by international consultants. That's one thing. Secondly, I'm started questioning the fact that consultants are saying they are independent, because some of them are not ready to give an opinion when we ask them to opine on a project. Unlike I see what telecom consultants do, because they are very, very strict. They slash projects by 5, 10 times. But when you look at the hotel consultant, and I know I've seen many of them on the exhibition there, they will always come with conclusion that this thing is actually viable. I want to give you an example. Very recently, I've asked one of them, because he presented his conclusion, and in the conclusion, there was no cash flows. And I asked him, what about the cash flows? He told me he was not requested to do, and I said, as a banker, how do you expect me to make the decision if I don't have the cash flow to show that this project can repay my money? So I'm not asking, are you guys, are you not connecting with our clients to come up with conclusions that the deals are viable, whereas they are not viable? What are your liabilities if we finance a project which is not viable?
Okay. Well, I would say, you know, if you receive a valuation without a cash flow, then I would just well, maybe ask for a second opinion. And I would say, yeah. Also, if the value is always on the high side, and always the evaluation is feasible, I think in the long run there may be this value is losing reputation. I think is getting its format, and it's really, you know, if he's also doing some negative messages one day, you know. Sorry, I think you've also made some negative statements, but of course I very much understand that in often cases there will be deals be done who shouldn't be done.
Right. Yeah. Successful study doesn't mean that the study is positive. Study can say also, don't undertake that investment. There are no assumptions for a project like this. But I think this is the seriousness of the consultant.
I think a good consultant, you know, when I was a good consultant, I would, you know, well, now we're internal consultants now, we're fantastic ones, but a good consultant will actually, you know, not necessarily, you don't need to actually end up doing the study at the end, right? So, you know, what we would do is you would go do the field work. And, you know, as you start analyzing, saying, look, there is no demand for a hotel, then, you know, we would call the client, say, look, we can continue issue a report that will tell you this hotel is not feasible, or give you projections that look awful, but, you know, we're willing to stop at this time, you know, refund you, you know, maybe keep the retainer, you know, expense the travel, but, you know, stop the study at that point. And I think that's for feasibility studies, you know, if you're talking about, you know, structuring the, you know, the contract with the consultant, that's a good point to be thinking about, is to build in, you know, kind of a stop point, right? You know, like phase one of the study is like, you know, maybe start with occupancy and average rate, and, you know, if you're seeing that it's heading the wrong direction, right, it's no point of finishing a study that concludes that the hotel is not feasible.
Of course, you are not going to develop the concept of that study.
You would think.
Okay. I think we are at the end of the session, so thanks for your interest in today's session. I think we were having a quite lively discussion about reliability of feasibility studies, and I would say we are be patient with the valuers. We also help them maybe one day to also improve their knowledge, because it's also our investors' responsibility to give them feedback, to tell them, you know, how performance have been maybe realized or not realized, so that they're also in a position to improve and optimize their results. We all think about these topics, and I all wish you a very successful conference here in Berlin, and a good and safe travel back afterwards. Thank you.